Hey everybody, this is Kevin, a CPA that does financial planning, and today I want to talk about turbulence, volatility, when the markets go downward, when your account values go down. And I want to share a couple things that I do to help myself, because not only do I have my own investments in the same place you do, but I also have a bunch of people, families, children. Their investments are in these asset classes, and so what I've learned over the last 11 years is a perspective, and that's what I'm going to share with you today. Now, it's not perfect, and it's not rainbows and puppy dogs every day. There's going to be times where we all feel stress, but if we look at this chart here, we see that stocks have had the highest return. This is 1996 through 2016, and this is from iShares BlackRock. And so they show that stocks have the highest return of any asset class. The thing is that many people don't know, or they know, but they don't believe when they start getting into them, is that stocks come with a big warning. The warning says flash could go down at any time for no reason or for a reason. Okay, many times we think that the stock markets go down because there's a reason, and when the reason comes out, we'll get out. The truth is that markets can go up and can go down. Usually they go up over long periods of time because earnings go up and dividends get increased. That's really what investing is, and that's why it's not speculation. But there is a form of speculation in all markets, and John Bogle calls it the speculative return. Sometimes the speculative return, everyone's really excited. Mr. Market is excited. It goes crazy. And other times everyone gets really pessimistic, and the speculative return goes negative. And so do I know if this slight market correction here is big or small? I don't. So the first piece of perspective that I can give you is using a flight analogy. We have over 50% of our clients are pilots. And so when you're taking off somewhere, what's the goal of the flight? I mean, the goal of the flight is to have a decent time, get there on time, etc. But it's really to arrive at the destination safe, right? That's really what you want the pilots to do, is to get you to the destination safe. Now, you would like to enjoy the ride. You'd like to have peace, not too much turbulence. But this warning sign with stocks, it doesn't guarantee you that you are going to have a perfect flight. It actually probably guarantees you that there's going to be turbulence because markets do go down. So what we need to do, though, is we need, during this flight, which is our investment horizon, is we need to have a destination decided when we are going to use this money. If our destination is 5 years, if we're going to use the money in 5 years, maybe you don't have that in stock. Maybe 25% of that money could be in stock. The rest has to be in shorter term, safer assets that are more over here, which would be money market and CDs. Okay? But if your destination is 10 or 20 years, what does it matter if there's a little bit of turbulence right now? It's funny, whoever we talk to, 30-year-olds, 40-year-olds, 50-year-olds, when the markets go down and the people that are maybe predetermined or just maybe pay a lot of attention and get upset, when you say, well, you don't need this money for 65 years, not 65 years, until you're 65, they say, yeah, but, and they bring their destination to this very moment. And by the way, it's easy to do that. It's simple to do that. So what should we do? Well, we have to continuously and on purpose remind ourselves where our destination is with these dollars. Okay, it's great to track your net worth every day on an app. It's great to watch your investments every day on an app. Only watch TV when things are going great. But as soon as markets go down and then your balance starts to go down, you get disappointed. And so you have to continuously remind yourself that your destination is not today. If markets do really good and you're doing great, we had a couple recently that said they didn't think they were doing well with us. And then we looked at their returns and they were fantastic. And they said, you guys don't go crazy about it. And we said, yeah, because it's a moment in time. And this is a young couple. This is a moment in time. What you really want is when you're at your destination to have the amount of money you need. And by the way, that's why we believe so much in having a financial plan and figuring out what your destination for each dollar is. If you're 70 years of age And most of your money's destination is now. In the next couple of years, which you should still have some money that's going to last if you live a long time. But if your destination is now, don't have that money in a volatile asset. And so that's something that we need to do together, though. And I would recommend that you talk to somebody about this. Even investors that do it themselves and have a great understanding, find someone else that does it themselves and talk to them about this. And then write down again how much money you're going to need at certain times of your life. If all your money you're going to need 20 years from now, okay, if you know that you're not going to retire until you're 65, you have a very stable job, and the market goes down in year 19, year 18, year 17 as you count down, it's really about the destination. So part of the reason why we get this way, though, is because we don't like to see those negative numbers. There's a visceral reaction. It's actually in the insula. We regret the fact that we didn't do something before, and then we get this massive rush of chemicals that tell us do something. And they say that your IQ goes down 15 to 20 points when you're under stress. And many of us can't lose those IQ points. We need those IQ points. So again, I think the easiest thing to do is to slow down the thinking, not get too stressed. And many of you don't get very stressed about it. You just want to maybe, reallocate, or maybe you're going to take some off the table now before the big market crash, or whatever. The issue is does it really matter what the market is doing in 2018 if the destination is 2046? Does it really matter? I'll just share one last thing with you. Charlie shared this with me. I've read this multiple times. I love it. So Charlie Ellis and Warren Buffett have both said this, but Charlie Ellis used to teach at Yale. And he used to say to the students, okay, you're all young. Many of you are going to retire later in life. Would you rather have the stock market go on a rip-roaring upward trajectory for the next 30 years? Or would you rather have the stock market immediately crash and then stay low for the 30 years? What would you rather have happen? And of course, all the people say they would rather see just a directly up in the next 30 years of the stock market. So what is that person doing in those 30 years? They're buying higher and higher and higher and higher and higher. The people, when the market goes down, if you're an accumulator, you're buying at lower prices. Now, again, if you get to retirement and still the stock market hasn't gone up, then you've only made the dividends. But the point here that Charlie Ellis tries to make, and that we try to make, is that if you're an accumulator, then the destination is not only far away, but you're going to continue to buy shares of great companies. And Charlie, in his newsletter recently, said it's more important what Southwest Airlines does and what Starbucks, how many coffees they sell, and are people using diapers? These are the long-term things that generate earnings growth and an increase in dividends. That is the reason why many people believe, and there's no guarantee here, but many people believe that companies will continue to grow their revenues, grow their profits, pay out dividends, and the destination will be a time, if we don't, during the ride, if we don't get too crazy, if we don't jump out of the plane or do something wild, that we can get to the destination with the plan that we have. So anyway, thanks so much for watching, everybody. I'm Kevin, a CPA that does financial planning. Thanks.